Welcome to session 2.5, which is in module 3, all about the cash flow statement. We're going to start by looking at the direct cash flow statement, and then we'll move on to the more popular indirect cash flow statement. So today we're going to look at the direct method, which is analyzing all your cash transactions and figuring out if they're operating, financing, or investing types of activities. Here are the cash flow basics. We are looking at the ways the business gets and gives cash. Sometimes that's called the sources of cash and the uses of cash. And we're going to focus on the direct method. And whether you're using the direct or the indirect method, this is the template for success. We're going to look and total up the cash from operating activities, which includes cash transactions on the income statement, plus changes in the current asset and current liability accounts. We're going to look at cash from investing activities, where those are changes in long-term assets. And here's the rules here. If the change is an increase, cash is going down. And if the change is a decrease, cash will be going up. More on that in a little bit. And the third activity type is financing, and those are changes in long-term liability accounts and contributed capital accounts. And here, if the change in those accounts is an increase, cash is going up, and if the change is a decrease, cash is going down. So what we're going to do is we're going to analyze our balance sheet and income statement accounts and identify whether they're operating, investing, or financing activities, and then find those numbers and figure out how does the company really get cash and how does it spend cash. So let's get started. Here we have Strauss, and we need to figure out from this cash flow statement, and this cash flow statement is a direct method, and I can tell that because notice it shows the source and the use of our expenditures. So in the operating activity section, it shows me how much cash came from customers, how much were paid in expenses, and how much was paid to our suppliers. So it's looking at the source and the uses of the funds. So what is the cash provided from operating activities? It is $17,500. What is it for investing? Well, cash went out of $20,300 because we acquired additional equipment. And when we look at financing, it's $13,000 coming in. So financing, investing, and operating. So then we look at what was the change in cash, and the change in cash overall, the net of the operating, investing, and financing, was $10,200. We add to that the cash at the beginning of the year, subtract, or to derive the cash at the end of the year. So cash at the beginning of the year plus or minus the change gives us the cash at the end. So that's the format, as you can see. All right, so let's get started on how we do this. So here's our template for success, and if I can do a journal entry, I can tell you whether it's an operating, investing, or financing activity. For example, if the company borrows $50,000 cash and signs a 10-year note payable, I know that I'm going to debit cash, my cash is going up, and I'm going to credit long-term note payable. Well, since long-term note payable is a long-term liability, this will be a financing activity. In number 2, we have 20 units of inventory are purchased from suppliers on account. So that's debit inventory and credit accounts payable. Notice cash is not involved here, so it's neither an operating, investing, or financing. And number 3, the utility bill is paid at the end of the month. That means I'm debiting utility expense and crediting cash, so I'm using cash. Utility expense is on the income statement, so that's an operating activity. Services are performed and the customers are billed $13,000. I'm debiting accounts receivable and crediting revenue. And notice no cash is involved in that transaction, so it's not on the cash flow statement. And number 5, 5 parcels of real estate are purchased for a total of $55,000 cash. Here I'm debiting land or real estate, and I'm going to credit cash. So since cash is in that, it's in the cash flow statement. Land is a long-term asset account, so it must be an investing activity. In number 6, a long-term investment in equity security, meaning that we own stock in another company. So I went out to the stock exchange and bought a stock, and I'm going to hold it long-term, so it's a long-term asset, and it's sold for cash. So there I know I'm going to be debiting cash, and I'm going to be crediting this long-term investment. So since cash is in that transaction, it's on the cash flow statement. Since it's a long-term asset, it's an investing activity. And number 7, principal payments are made on outstanding debts. Outstanding debts, it's a current liability, so I'm going to debit a current liability and I'm going to credit cash. Since cash is involved and it's a current liability, it's an operating activity. And finally, cash is received from customers for services completed in the previous period. That means I'm debiting cash, and I'm crediting accounts receivable because I did all the work and sent them the bill last period. So since cash is in that transaction, it's a current asset, it's an operating activity. So hopefully those transactions that didn't have cash in them didn't trip you up. So here again is the answers. All right, here's some more. We're going to prepare journal entries and put them in the T account for cash. And then we're going to do a beautiful, quick cash flow statement. So notice that beginning cash is $5,000. So let's go to the next slide and talk through the answer. So cash has a beginning balance of $5,000. In number 1, we issue 600 shares of stock for $25 each. I'm debiting cash, crediting common stock. Since common stock is contributed capital, it is a financing activity. So notice I put number 1 and I put a big F by it to show that it's financing. In number 2, we sold services for $4,000, and notice it says here each of these is a cash transaction, so it was a cash sale. Debit cash, credit revenue. So number 2, cash is going up by $4,000. In number 3, we paid wages. So we're debiting wages expense, crediting cash. Since wages expense is on the income statement, it's an operating activity. In number 4, we purchased land as a long-term investment for $9,000. We're going to debit land, a non-current asset, and credit cash. So it is an investing activity since it's a non-current asset involved there. And number 5, it's a new one, paid $2,000 in dividends. Since dividends is a shareholder's equity account, it's going to be a financing activity. So notice that it's financing because we use cash to pay dividends. And number 6, we sold land with a book value of $3,000 for $3,500, which meant we had a gain of $500. So how much cash did we get on that sale? We got $3,500. So since the amount of cash we received from the sale, the investing activity is $3,500 because that's the cash that flowed in, or the source of the cash. And number 7, we paid $1,500 to the bank, $900 to reduce the principal of an outstanding loan or a note payable, and $600 for the interest. So how much cash did it take? $1,500. Since we're assuming a long-term note, it's going to be a financing activity. If it was a short-term note, then it would have been an operating activity, but we're assuming it's long-term. And number 8, paid miscellaneous expenses, $1,800, debit miscellaneous expense, credit cash, $1,800, and that's an operating activity. We total it up and we find that ending cash is $11,600. So let's do a cash flow statement now, which resorts this. And we total up our operating, investing, and financing activities. We have our beginning cash plus our change in cash. So our net operating was a cash outflow of $900. Investing was a cash outflow of $5,500, and financing was a cash inflow of $13,000. So our change in cash, delta, change in cash, was $6,600. Add that to the beginning cash, and wow, it comes out to be exactly what we have as our ending cash balance, $11,600. So that's how you prepare a direct cash flow statement. You look at all the cash transactions, sort them by operating, investing, and financing, and do a nice statement. All right, here's another one where we have a whole bunch of transactions. I bet we're going to make those transactions, put them into a cash account, identify them as operating, investing, and financing, and then make a beautiful cash flow statement, the direct method. So let's look. Here we go. So in number 1, if we sold common stock, it's a debit to cash. So it's financing because it's stock. Number 2, since there's no cash involved, it's a trick question. Number 3, since we purchased new equipment for cash, it's an investing for $5,000. And number 4, we collected on accounts receivable. Accounts receivable is an operating activity because it's a current asset. Number 5, we made payments to suppliers. That is an account payable. So again, it's an operating activity. In number 6, we declared and paid a dividend. Since dividends is shareholders' equity, it's a financing activity. And number 7, when we paid rent for the last 6 months and for the next 6 months, those are current liabilities and rent expense. So those are operating activities. And then in number 8, when we made sales, some of it was on account, so that's a nothing, and the remainder, or $65,000, was in cash, so that's an operating source. In number 9, we paid $40,000 cash for miscellaneous expenses. That was an operating activity because it's expense. And in number 10, when we sold investments with a cost of $20 for $25, $25 was the amount of cash we received, so that's the investing activity source. We total it up. Beginning cash was $25,000. Ending cash we find is $67,000. We sort our operating, investing, and financing, and find the net difference. And now it's time to do that beautiful cash flow statement. And there it is. All right, here's one where it's CSI accounting. They want to know how much machinery was purchased during the year and how much cash was collected from the sale of the machinery. So you're going to reconstruct your T accounts here and find the missing numbers. So for machinery, we find that beginning machinery, I'm going to change my colors, is 20,000. Ending machinery is 45. We know that there's only two things that can happen in machinery. It can be increased when we buy it, and it can be decreased when we sell it. And it tells us that 8,000 was sold during the year, so that's where that 8,000 came from. So that means we bought 33,000. And if we bought 33,000, then that is a, investing, you're right, investing cash flow item, isn't it? And that will make the investing activity. We used 33,000 cash to buy machinery. Now, we also have to look at our accumulated depreciation, which started the year at 10, went to 15, and we know that the depreciation expense for the year was 7, that's right here, and we know then that the depreciation on what we disposed of has to be 2,000. So that's where that number comes from. We know that the machinery we disposed of was 8,000, and we know that the gain was 2,000. So what's the missing number? How much cash was the old machine sold for? It was sold for $8,000 cash. So what are the answers? 33,000 was the machinery we purchased during the year, and the cash sales price on that machine was $8,000. So hopefully you've enjoyed the direct method. Oh, two more things. Here's a ratio that's important because you want it to be more than 1. And the reason you want it to be more than 1 is you want cash generating from operating activities to be greater than your accrual-based net income. So cash flow operating activities, which we're going to learn about next, is basically your cash net income, or your revenue that was received in cash and your expenses that were paid in cash. So that's the cash flow from operating activities. Accrual-based net income is how we find net income. Remember, revenue is recognized when it's earned, and expenses are associated with that revenue show up to find your net income. So, are there operating activities sufficient to cover your cash flows? Greater than 1, you're having more cash. In other words, what we call the blood of the business. You need cash to keep your business running. Is greater than the net income on that income statement. So that's the cash flow yield. Free cash flow is another thing to look at, where you take the cash flow from operating activities and you subtract out the dividends that you're paying to your shareholders, and you subtract out your net capital expenditures, in other words, what you bought versus what you sold, to come up with, do you have anything left for other uses during the year? And that's called your free cash flow. Now, there's some advantages and disadvantages to that. The deficiencies of free cash flow is it's a squishy definition. Not everybody defines it that way. And it gives you an absolute amount. It's not a ratio, and it's not really clear if it's good or bad to have free cash flow. So the only truly free cash flow is from operations. In other words, after you pay your current bills, do you have something left in which that you can use in a variety of ways? So a lot of times they'll define free cash flow like you and me is after I paid all my bills, is there anything left?